Good morning and welcome to this Tuesday, October 10th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes as we prepare for the open just ahead. Yesterday, not a bad day. We did start off in negative territory. We've got a little bad news with the Middle East conflict. I think that maybe triggered a little bit of selling at the open, but the market did come back. We finished fairly strong and green across the board, which was good news. Seems like the market's in a little bit better spirits than it was certainly the last few weeks, maybe even the last couple of months. And we are into the more bullish historical period for U.S. equities. So I think the combination of all that certainly has helped the market try and regain its footing. We are trying to get back through a couple of key levels on the S&P 500. We're going to go into all that in just a minute. First, let's go ahead and take a quick look at the recap. And while I'm pulling this up, I can tell you futures this morning turned just slightly green. They've kind of been mixed overnight, little red, little green, but right now looking for a little bit of strength at the open. Just pulling up the ETFs that track the major indices in real time pre-market. Right now I'm showing the diamonds. The DIA tracks the Dow Jones Industrials up about 0.2%. The spider, which of course tracks the S&P 500, up a little bit, well, barely 0.06%. The QQQ, of course, tracks the NASDAQ 100, is flat at the moment. And the IWM, which tracks the Russell 2000, also flat. So not really a whole lot going on. Like I said, we did have a big move yesterday in defense stocks. I think we could see that continue. Would not be surprising. Usually when these stocks get going, they tend to move pretty quick, especially when there's an event like we saw over the weekend with the attack on Israel. The Dow Jones Industrial Average finished yesterday up 197 points. That's 0.6%. S&P 500 up 27, also 0.6%. NASDAQ up 74. On a percentage basis, just slightly lower, up about 0.5%. Didn't really see a whole lot of leadership yesterday in technology, communication services, or consumer discretionary. So as a result, saw a little bit of underperformance in the NASDAQ. Mid caps up 0.75%. Small caps up about 0.6%. Transports up 0.9% to lead all of those indices. But across the board, we saw all 11 sectors higher yesterday. Starting with energy up 3.34%, industrials 1.5%, and a real estate beaten down group starting to show a little bit of life here. Real estate up 1.3% yesterday. The oil patch very strong, of course. You can see the DJUSOI, which was up 4.5%. Then we had the DJUSDN, that's your defense group, up 9% on the day. Huge day for the defense stocks. And aerospace up 2.4%. So those were your primary leaders yesterday. A lot of movement in the market directly as a result of the conflict in the Middle East. Oil prices went up. Oil prices have just been all over the place. Made a big move up into the mid 90s per barrel, dropped all the way back down to about 82 a barrel. And then yesterday, not sure where we finished, but I think it was up around $86 a barrel. So started to make a move back to the upside. And of course, that led to many of the industry groups within the energy sector performing very well yesterday. And then defense stocks, aerospace stocks, areas where you would expect maybe to see a little bit of strength when we have a new conflict, especially one developing in the Middle East. Let's keep moving on. The 10-year Treasury yield. So yesterday, the bond market was closed. It was Columbus Day, so banks, bond market closed. Stock market was open, though, had a full day on the stock market. 10-year Treasury yield clearly was flat yesterday since it didn't open. But today, I'll give you an update here, but we are down quite a bit on the 10-year Treasury yield. Right now, down about 9.5 basis points to 4.70%. Couple of points here technically on the chart. That tail where we went up to 4.90% on Friday intraday, that was after the jobs report. Remember, it was much stronger than expected. We saw a lot of selling in bonds as a result, which makes a lot of sense. If you're worried about the Fed and you're worried about the inflation, a hotter than normal or hotter than what was expected jobs report could lead to some additional restriction from the Fed. Fed could come out and say, hey, we're going to keep raising. And so as a result, and talk more about inflation as well. And as a result, bond investors flee because they want more yield to guard against higher inflation. So that's the way it started. And we saw that yield jump up because of all the selling in the bond market. But then we had buyers return. And by the end of the day, we actually had failed on the latest breakout attempt up near 4.80%. So that long tail to the upside with a shooting star candle, many times that'll signal a top, at least a short-term top. It's nothing that means anything long-term. A lot of times candlesticks, we're just looking for short-term signals. And that was one of a potential top. I looked back, and the only one I really saw at recent tops that looked similar was probably back at the end of May. And you can see these two candles right here at the end of May, where we broke out, and then the very next day we gapped down, and then we took off again intraday and failed, came back down and failed. Wouldn't exactly say that was a shooting star, because normally what I expect with a shooting star is a gap up and then movement to the upside, and then you come back down, normally still finishing higher for the day. This one's a little bit different, but it did put in an intraday high before reversing, and you can see the next 2 or 3 days, just a short-term little move back to the downside before we resume that uptrend. I don't know if that's what's going to happen here, but at least there is a signal of a false breakout, which normally would lead to a little bit of short-term weakness in the yield, which means buying of treasuries. So that's what I'm expecting near term. I think we could go back down to about 460 on the yield, and then we'll see what happens. Remember, the next 2 days, big inflation reports coming out. The September PPI will be out tomorrow at 8:30 a.m. Eastern. And then on Thursday, we've got the September CPI out, and that's going to be a big number for the Fed. We've seen inflation the last 3 months. I know the Fed's saying, hey, we want to see it move down toward our target rate. But if we take the last 3 months readings on the CPI, which I believe is around 0.16, and 0.28, which would give us 0.6, and that's over the last 3 months. If you annualize that, you multiply it times 4, that would give us 2.40. So the last 3 readings on the CPI have been at the annualized rate of 2.4% inflation rate. And that's pretty darn close to what the Fed's shooting for. Now, this reading, the September CPI reading, I do believe is expected to come in at 0.4 or somewhere around 0.4. So if we're in below that, I think we could see a melt up in the market. If we're at 0.4, I don't know, maybe we pause. I think if we're above 0.4, let's watch and see what the market does. Maybe we have one more push to the downside. I don't know. I think it is going to be a little bit data dependent, but just kind of keep those numbers in mind, because I think if we're still down around that 0.3 level and we get a 4th consecutive reading that's showing that inflation is getting back close to that Fed target, it's really hard for the Fed to argue that they need to continue to raise rates. Continuing to watch the action, watch the data, okay, sure. But to continue raising, I think, is a stretch, given the fact that inflation seems to be moving back into that range that the Fed's looking for. Anyway, next 2 days is going to be really important, especially the CPI. PPI, sometimes you get jumps in the PPI, but it doesn't get passed along to the consumer. And I think the Fed's really more interested in what's going on at the consumer level. So I think the CPI report's going to be the big one. So let's watch for Thursday morning and see how that report comes out. But I do like the fact that we're seeing the market move away from recent lows to give us potentially some downside room, just in case that CPI report is a little hotter than expected. All right, moving on. The S&P 500 did move up. You can see sitting almost right on the 20-day moving average. So when I talked about the S&P 500, when I've been talking about it recently to the upside, what I kept saying was, first thing we needed to do is we needed to clear 43.05. Well, if you look back to Friday of last week, we closed at 43.08. Not exactly blowing the doors off resistance, but moving back up above that initial level at 43.05. The second level I talked about was about 43.35. which was the declining 20-day EMA. Here's the deal. Technically, when you're trending lower, and a lot of folks think we're going down, that this is still the continuation of a bear market, we're going to go back down maybe to those October lows last year. Well, one step to do that is to remain in a downtrend. And one sign of a downtrend is when you fail at 20-day moving averages and you go back down and you set new lows. Well, we came back up. We closed yesterday on the S&P 500 at 43.3566. The 20-day EMA is at 43.3623, less than 1 point below that 20-day EMA. So just in the last 2 days, the 43.05 level has been taken out. That's a price resistance level. And then 43.35, 43.36 is now being tested. And that's your 20-day EMA. So failure here, if the market were to go back down the next few days and go back down to new lows, that certainly is looking a little bit more bearish. And I'm sure that's what a lot of bears out there right now would like to see. The flip side, however, is that if you go back through the moving average, the 20-period moving average, with a PPO that had been pointing straight down, that normally is an indication of a trendless market or sideways consolidation. So that's much more, moving back up through the 20-day is much more consistent with a sideways consolidating or with a ABC correction kind of a move than it would be a continuation to the downside. So I think we're at a key level right now. Watch this 20-day EMA and see if the strength from the past few days continues and the momentum takes us back up above the 20. And let's see if we can close there. Then we've got perhaps on these inflationary reports coming out the next 2 days, perhaps that 20-day serves as support on the way back down. That's a possibility. Just throwing out different ways that I'm looking. I try to look to see what, looks bullish to me, what looks not so bullish or bearish, downright bearish, and then see how the market reacts. And then I can adjust accordingly. The NASDAQ 100 has now moved up above its 20-day 2 days in a row. It actually cleared on Friday. And then yesterday, after gapping down, did come back up, close up 0.5%, and pretty close to the 50-day moving average, which is at 15,095. And we finished yesterday on the NASDAQ 100 at 15,047. So not very far to go to get to that 50-day moving average. We'll see whether or not that holds. As we look at price action, this is actually an index that's been doing a little bit better in terms of trying to hold on to recent lows back in June and then again in August, staying, well, actually maybe moving just slightly below, but for the most part, kind of holding on to this area of support. If we look back at that S&P 500, I think you'll see a little bit different picture where we're clearly below those two lows. So moving back above the moving averages in this case with the S&P 500, I think is a little bit more important. The IWM continues moving down, but for the fourth straight day now, we do have hollow candles. Remember, kept talking about how the distribution was rather significant. We kept seeing red-filled candles or even here a black-filled candle. And we went, I don't know, something like 13 out of 15 days where we closed below the open. Well, now we have closed above the open 4 straight days. So definitely a little different feeling to what's going on in the market right now. I would say we did move back down below 170. And if you look on the IWM, 167 to this 170 zone is where we have seen major bottoms over the course of the last year. Looks like maybe we've done it again, but the IWM has even more work to do than either the S&P or the NASDAQ in terms of trying to get through its 20-day EMA. It hasn't even reached it yet. In fact, that's up at 176.65. We're sitting at 174. That's 260. That's about 1.5% away from just getting a test. So IWM small cap still underperforming, but looking better certainly in the near term. Moving on to the transports. Transports, a couple of decent days actually testing that 20-day moving average. Have we bottomed? PPO says, I don't know, it's kind of a very, well, not even a subtle positive divergence. It looks like it's still setting new lows on the PPO with price action moving down. But a move back up above the 20-day, especially a definitive move through the 20-day would be first of of that kind in probably the last 6-7 weeks. So that would be a good start to perhaps setting up for a fourth quarter rally, getting back up above these 20-day moving averages across the board. Again, we've seen it in the NASDAQ 100, but that's it. Not seeing it anywhere else just yet. So we still have a lot of work to do, but it is nice to see things starting at least to turn. I know those on the bear side will say, hey, not going to go down every day. This is a bounce. Maybe so. I think with the inflation reports out the next couple of days and the reaction to those reports, I think we'll have maybe a little bit more clue there. All right, chart of the day. I want to first take you over to earningsbeats.com. For those of you who are new to Earnings Beats, maybe just tuning into the show for the first time, first, I want to thank you. Really appreciate all of you out there who have been supporting us for so long, following us here on YouTube or following me over at Stock Charts with the blog articles that I do, many of the shows that I've done over the years. And of course, to all of you who have subscribed at Earnings Beats and become paid members. We do all of this because of you. So certainly a big thank you to all of you. If you are watching this live stream for the first time, please make sure you subscribe to our channel. Anytime we go live, you'll be able to join us, especially make sure your notifications are tuned in. But we do these live shows 3 times a week, Tuesday, Wednesday, Thursday, 9 a.m. So if you stumbled upon us today, make sure you check us out Tuesday, Wednesday, Thursday. You can always check in. And I think we take a little different approach to forecasting the market and analyzing the market. Personally, I think it's a better approach. We combine a lot of things. It all starts with technical analysis, but I think that there's a lot of common sense perspective and things that we throw in there with some fundamentals. I think that makes our approach maybe a little bit unique. And so again, I want to thank all of you for following us and supporting us over the years. All right, here at earningsbeats.com. First of all, if you don't really know much about us, we do have a 30-day free trial. So you can start a 30-day free trial, come in and get everything that we have to offer at Earnings Beats, which I think you're going to find is quite vast. You might need all 30 days just to figure out all of the services we provide. But come on in and check us out. I think you'll like it. And if you just want to learn more about us and how we approach the market, and you're not ready to make a commitment to join, go over to our Earnings Beats Digest. You can just scroll down at our homepage, put in your name, email address, hit that subscribe button, and that will get you set up. It's a 3 times a week newsletter, Monday, Wednesday, Friday, and it's very quick. It's 2 paragraphs in a chart generally. So great way to learn more about the things that we like to follow, our approach to the market. We talk a little bit about, obviously, stocks, earnings, gaps, candlesticks, get into intermarket analysis, sentiment. Sentiment has such a huge impact, not only in the short term, but also the long term of the stock market. You really have to understand all the different pieces of the puzzle to try to, get the upper hand in the stock market and actually turn the tables on Wall Street. But this is where it starts. Please go to earningsbeats.com, scroll down, and make sure you get signed up. It's a free newsletter. And you know what? If you want to unsubscribe, unsubscribe. It's your choice. Easy to do. I think you'll like the newsletter, though. Most of the folks that subscribe stay subscribed, and for good reason. All right. Let's keep moving on. So for the chart of the day today, I'm going to go back to the 10-year Treasury yield. Remember, I talk about this every day at the show. During the show, I talk about upcoming earnings reports, and I show you what's going on with the 10-year Treasury yield. And we've been going up now for the last 5 months pretty steadily. And if you look down here at the bottom, I don't usually talk about this, but I have 2 relative charts that I like to feature. One is the XLF, which is the financials ETF relative to the S&P 500, and the industrials ETF, the XLI, relative to the S&P 500. And the reason I like to show these is that normally what you see, and normally the correlation here, is that when you've got rates going up for all the right reasons, then normally we will see financials on a relative basis going up and industrials on a relative basis going up. Well, notice over the last 5 months, rates have been going up, but the financials on a relative basis have been mostly flat. Industrials on a relative basis have been mostly flat, a little bit more volatility in this group, but generally, if you look back over the last 5 months, pretty flat. pretty flat, rates going up. Now, if you think about it, and I said, when rates are going up for the right reason. So what do I mean by that? Well, the 10-year Treasury yield normally will move up for a couple of different reasons. One would be either economic strength. One reason that you would want to get out of bonds is when you have economic strength, because you want to be in stocks. When we got economic strength, companies are doing more business, profits begin to move higher more rapidly, earnings valuations, PE ratios go up. And so normally you want to start moving a little bit more away from fixed income and move into something like equities, where you can participate from the rising profits from the stronger economy. It doesn't have to be stronger economy. It can be just the expectation of a stronger economy. And then we get that stronger economy later. So it could be either of those two that sends the yields moving up because folks get out of bonds. But if that's the case, if the economy is strengthening, we should be seeing the XLF starting to perform better on a relative basis. And we also should see industrials performing better. So when I see the yields moving up and I don't see these two moving up on a relative basis, it starts to make me think that it's moving up for the other reason. And the other reason is inflation. So inflation, if you think we're going to have, rising inflation that's going to stick for a while, you sell bonds because you don't want to own bonds when they're at 3.5, when they're yielding 3.5%, 4%. Why? Because if inflation's at 6 or 6.5% and you're in a 4% bond, you're losing money. You're actually losing ground. And so it doesn't make a whole lot of sense. So you sell, you get out of bonds, maybe you get into real estate, maybe you get into gold. But if you look at real estate and gold, they haven't been performing well at all. So the stock market's saying we don't have an inflation problem. So right now, I think the market's just kind of teetering. And personally, I think based on the signs that I'm seeing, the intermarket relationships and so forth in the stock market, I believe that we're going to see eventually a top in the 10-year Treasury yield. Now, I do think we've moved into a completely different environment. I had a question that came in recently and said, do you think we're now moving into a bear market in bonds? Because we've had a bull market in bonds since the early 1980s. Bonds, we've been buying, and we've seen the yields going down, down, down. And so do I think that now we're in an environment where we're just going to have to live with rates continuing to go up? I don't think that, but I do think that the long-term 42-year downtrend is over. Because if it continued, we'd have to go way below zero. And I don't think that was going to happen. We got down almost to zero. So I think the long-term bull market in bonds and the bear market in yields has ended. But I don't think we're going to go shooting straight up, not now. And I think it's way too early to talk about what might happen in 10 years, because I do think down the road we might have some problems. But I think the rest of this century, or the rest of this decade, I think we're probably going to have rates that go up and down, probably somewhere in the 3 to 5, maybe we go 5.5. I don't know. But if we get above 5, I think 5 handle is going to start to spook some folks. And if you start seeing income investors leaving the market and starting to move more into treasuries because the yield's so high, then I think you're going to have a situation, where the stock market could be running into some problems. Personally, again, it's just my feeling, my opinion. I don't think that yields are going to be a problem for a little while. And I'll just leave it at that. I think we're going to see the 10-year start to come back down. The Fed's already talked about cutting rates next year. They said 4 originally. Now they're saying they're going to cut twice. I think rates are going to come back down. I think the Fed is just wanting to make sure that the rate of inflation, which has now been declining for a good solid year, continues. And they're not going to take any chances. They see any blips and they're going to talk tough, and they might even raise one more time. But I do think eventually we're going to see the yields roll over. So getting back to my point about the XLF and the XLI, that's why I don't think we're seeing these two move just yet. I want to show you a long-term chart. This is your chart of the day. So I want to show you a long-term chart. This is going back 15 years. This is the 10-year Treasury yield on a weekly basis. And down below I have the correlation of the 10-year Treasury yield, the direction of the 10-year Treasury yield versus the direction of the relative strength of financials. So if the 10-year Treasury yield is going up and the relative strength of financials is going down, we will see inverse correlation or negative correlation, and we'll see this move down into the minus 0.50 to minus 1.0 range. But if the two go together, if financials outperform the S&P while the 10-year Treasury yield goes up, then we have positive correlation, and we'll see that up here in the blue shaded area. Now, I want you to look at the blue shaded area and the red shaded area and tell me whether or not you see positive, more positive correlation or negative correlation. And if you answered more positive, I think it's pretty clear. Look at all of the readings. I mean, many times we're up at plus 1.0. We've probably hit 1.0 maybe half dozen times over the last 15 years. But we've been into this blue area, this blue shaded area. I mean, I'm not going to count the times, but it's been dozens and dozens over the last 15 years. How many times have we been down this red zone? You can count those in one hand, maybe. 1, 2, 3, 4, 5. 5 times. So what we're seeing right now with the financials not performing well versus the S&P 500, while yields go up, it's really kind of unusual. And right now we're still in positive, but starting to roll over. Remember, this is weekly, and what we look back over it here was daily. So this was a daily. So you got to remember, weekly is going to take a little bit longer to get going. But it's pretty clear to me that generally, and there's a good reason for this, by the way, because in this century, we really haven't had any battles with inflation. And so normally we're going to see yields going up when the economy is strengthening. And when the economy is strengthening, financials tend to do well. And so there you have this relative strength, or the positive correlation, which shows relative strength when the 10-year Treasury yield's going up. Down the bottom is the industrials. Look, same thing. I mean, when I'm looking at the positive correlation, I see a lot more trips into this blue shaded area than into the red shaded area. Now, are either of these perfectly correlated? No. So, you know, when I look at things that are more strongly correlated to the S&P 500, it would be something like the XLY versus the XLF, which is consumer discretionary stocks versus consumer staples. And there, I mean, that positive correlation is with the S&P 500, not the 10-year Treasury yield. But that positive correlation is one that I've been looking at for many years that I think gives us tremendously accurate predictions about what the stock market's likely to do. So I use that to help me manage risk. These two, it's more about just trying to figure out when they're going to lead and when they're not. These are 2 of the 5 aggressive groups, financials and industrials. The other 3, of course, technology, communication services, and consumer discretionary. Most of the time during bull markets, these 2 will take a back seat. Financials and industrials tend to take a back seat. They normally kind of go along for the ride. The S&P 500 goes up, they tend to go up with it. But we go through different periods, and usually when we see the rates going up, that's periods when we'll see some outperformance in the XLF and XLI. But if you notice, during the last 10 years of the bull market, rates have been going mostly lower. We have bounces to the upside, but mostly been going lower. And we've seen those other aggressive areas outperform financials and industrials. As rates have moved up, we've seen a little bit of a change, although recently, with rates going up near 5%, we've seen those 3 aggressive groups doing better than these 2, which again, I think points more to maybe the market's concerned more about inflation than telling us what a great economy we have, or economic picture that we have. So I think the Fed's going to lower to try and bolster the economy, but they're not going to do it until they realize that they've won the battle with inflation. And I think that's where we stand right now. All right, it is 9:30 right on the nose. So let's take a quick look, see if we've got the action here. We do see the market up a little bit here at the open, continuing the recent strength. I wouldn't be surprised to see that continue. The VIX back down to 17.5. Remember, it was up near 20. It is starting to roll back over and move back down. We can see we had a little bit of a pop yesterday early on when the market, or actually late when the market did pull back just a little bit. But overall yesterday, you can see this was a big down move in the VIX. I wouldn't be surprised at 1751. We've already taken out yesterday's low. I think the VIX over the course of the next couple of weeks is going to meander lower. And I think the market goes back higher, but we'll see. Remember, 2 big inflation reports coming out the next couple of days. Be careful out there. Everybody have a great day. Happy trading.